Hi, this is Tony Sagami. Hey, I want to do a little dissecting today of Yum Brands because I think it gives you a very good idea of comparing what's happening in the U.S. economy compared to China. Yum Brands, as you probably know, is the manager of KFC, Pizza Hut, Taco Bell, Long John Silver, very successful fast food chain. And they reported a pretty good quarter. Wall Street was pretty impressed. They reported a 69-cent increase in profits, and that's 69 cents of profits. That's a 19% increase over the year before. Sounds pretty good, doesn't it? On the surface, that does sound good. 19% growth is pretty good. But if you dissect it a little bit below the headline number, you'll find a very different story. And I also think it tells you a lot about what's happening between China and the U.S. Quite different paths. First of all that growth that they had, their sales were actually flat if you would have backed out the currency gains. You know, the dollar's been falling, and that's very good for companies that do business overseas when they translate that back into U.S. dollars. Yum Brands is no different. They get more than half their sales from outside the U.S., so the falling dollar really helped them. If you would have backed out the currency gains, their sales would have been absolutely flat. And so that's hardly any growth. That's not growth at all. At the same time, their same-store sales in the U.S. were down by 6%. That kind of shows you how tough the U.S. economy is. Even inexpensive fast food restaurants are having trouble, and the 6% sales drop is pretty bad. It's even worse at Pizza Hut. Pizza Hut was down 13% same-store sales in the last year-over-year quarter. So that's a telling sign. You know, this is kind of a little connect-to-dot thing, but Kraft owns DiGiorno Pizza, the frozen pizza. Their sales were up 20%. So Pizza Hut was down 13, DiGiorno was up 20, so you can see the difference where cash-strapped consumers are, at home a little bit more. At the same time, there was a giant drop. It doesn't sound giant. It's 5.8% drop in the cost of goods, whether it was cheese, wheat, mushrooms, pepperoni. Prices of the commodities dropped by 5.8% for Yum Brands. That doesn't sound like a lot, but it translated into 30 cents per share of profits. 30 cents. So that, compared to the 69, shows you how much of that profit came from falling prices, not from organic growth. And then lastly, all that good news that they did have, what little there was, came from Asia. Let me give you an example. Their same-store sales in China grew by 11%, contrasted the 6% drop in the U.S. At the same time, they opened 88 new stores in China in the last 90 days. And to put that in perspective, in all of 2008, they opened 500 stores. And they still plan on opening 1,400 more in the next by the end of 2010. And so that growth is still happening over there. And profit-wise, instead of a sales drop, I said they had a sales growth, but they had a 32% year-over-year growth. And that shows you how powerful not only the sales growth, but the profit potential is in China. So I'm not suggesting that you run out and buy Yum Brands. As a matter of fact, I don't think I'd touch it until it dropped below 30. And I didn't say rush out and buy it at 30, but take a look at it under 30. So it's still a little pricey for me. But the purpose of telling you this story is to show you the difference. And I think what's happening with Yum Brands is a very accurate microcosm of what's going on with U.S. stocks versus Asian stocks. And there's no question in my mind that the place you're going to find the growth, just like Yum Brands has found, is going to be overseas across the Pacific Ocean. I'm not telling you to dump 100% of your stocks, U.S. stocks, but you better have a very heavy weighting of the Asian equities, because that is definitely where the growth is. This is Tony Sagami signing off till next week.